The US dollar falls again, ahead of a widely expected Fed rate cut early tomorrow morning. Australian consumer confidence about the long run hits a 15-year low, and New Zealand house prices were flat in August. That's coming up in our 5 Things in 5 Minutes on Wednesday, September the 17th. And then, in our deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, looks at the big picture for the US dollar and its focus on US Federal Reserve Chair Jerome Powell's comments tomorrow morning.
If the chair is more dovish than expected, of course you would expect that to weigh on the dollar. But really, how much more bearish can he get from here? We've got already more than 5 cuts priced in for the cycle.
But first, in 5 and 5 with ANZ, US stocks are in a holding pattern ahead of the Fed's rate cut, widely expected to be announced at 5 a.m. tomorrow morning Australian time. But the US dollar kept falling overnight with lower bond yields and market rates. The US dollar index fell another 0.7% by 4 a.m. Sydney Melbourne time. The Aussie dollar up 0.3% to 66.87 US cents, and the Kiwi up 0.3% to 59.90 US cents. ANZ head of FX research Mahjabeen Zaman says markets and currency traders will be watching both the size of the cut and Chair Powell's tone in a news conference shortly afterwards.
The data so far does, on the job side, on the inflation side, does reinforce that a rate cut is fully priced in. So with that, I think the attention will really shift to the FOMC communication and Chair Powell's tone on the pace of future easing and what that will do for the FX markets. Of course, if the chair is more dovish than expected, of course you would expect that to weigh on the dollar. But really, how much more bearish can he get from here? We've got already more than 5 cuts priced in for the cycle.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq were flat. The yield on the 10-year US Treasury fell 2 basis points to 4.02%. Gold rose 0.1% to $3,723 US an ounce, having hit another intraday record high earlier of $3,739 an ounce. West Texas oil futures rose 2.2% to $64.72 US a barrel. Number 2, Australian consumer confidence fell last week to its lowest level since mid-June, according to the ANZ Roy Morgan survey. Here's ANZ economist Sophia Angala with one particular standout milestone within the survey results.
The decline in the consumer confidence measure was broad-based, and looking to the sub-indices individually, we did see in that medium-term economic confidence, so that's household economic confidence over the next 5 years, that series decreased to its lowest level over the last 15 years. On the other hand, the short-term economic confidence sub-index, so that's household confidence in economic conditions over the next year, also eased as well, and that fell to its 5th weakest result in the year so far.
Number 3. So our Sophia, why are Australian consumers more worried now about the economy in 5 years than they were at the worst point of COVID in 2020?
So recession concerns in the US following the deterioration in the labor market data during the survey period last week may have supported that drop in medium-term economic confidence. But when you look through to domestic economy, we're actually seeing a pretty resilient labor market and a local economy.
Number 4. House prices in New Zealand were flat in August after 2 months of slight falls, as reported by the Real Estate Institute yesterday. Prices over the last 3 months are up 0.2% from the same period a year ago. Volumes fell 3.8% on a seasonally adjusted basis in August from July. I asked ANZ senior economist Matt Galt why New Zealand's housing market was so stagnant even after 250 basis points of rate cuts by the Reserve Bank of New Zealand in the last year.
Partly it's just been the New Zealand economy's stayed fairly weak through 2025 so far. So that's seen job security stay reasonably poor. And the other side of the coin is that interest rates aren't super low yet, particularly if you're looking at the kind of 3 to 5 year mortgage rate space. Interest rates are back kind of around their neutral level.
Number 5. We also got selected price indices data from New Zealand yesterday, showing rents, food, electricity, domestic airfares, and accommodation and fuel fell overall by 0.4% in August from July. That was more deflation than the 0.2% that ANZ senior economist Miles Workman had forecast.
The upshot here is the August data has alleviated some concerns that we had that CPI inflation could in fact breach the 3% target band in Q3. With the August data in tow, that scenario is looking just a little bit less likely, and we remain quite comfortable with our forecast that inflation will come in at exactly 3% year on year, which is identical to the Reserve Bank's August MPS forecast.
Miles Wickman there. Now, in a deep dive interview, I spoke with ANZ's head of FX research, Mahjabeen Zaman, on the fringes of the AFR Asia Summit last week, which is why there's a bit of background noise. I asked her about the US dollar's big moves this year and what to expect later in 2025.
The number one driver of the dollar moving lower is US policy uncertainty. Now, do we think that's going to pare back? Probably not, the way things are going. We are in a flux of change, and I think that's going to be in front and center of the FX moves. But bottom line is the direction for the dollar is clearly lower. We don't expect a huge crash, but a gradual, slow adjustment to levels which are a little bit more normal. You would call it normalization of the dollar rather than a crash.
And how important is the Fed's decisions, the US economy's growth levels, jobs levels, inflation levels in that trajectory for the US dollar?
Look, I think with all the changes that are happening, surely we do expect the US growth story to be dampened slightly. Just starting with trying to understand what the current administration wants. Now, do they want a weaker dollar to promote their exports and their reindustrialization plan? Or do they want a stronger dollar to offset imported inflation now that it will come in via the tariffs? Or, which way do they want to go? That's something we're trying to assess. The other point is we need to know what they definitely don't want. And that is a weaker dollar going hand in hand with higher bond yields. And that talks to confidence, right? Confidence around the dollar. So that's probably something they don't want. So at the end of the day, bond yields are reflecting that term premium. Investors, with all the shifts happening in the US, investors are asking for additional income on the back of what traditionally they would expect on longer dated bonds, on taking a risk of investing in the US.
One of the themes of the conference so far is the apparent resilience so far of the Asian economies to the Liberation Day tariff shocks. How is that playing out in FX markets and interest rate markets?
Look, I think we are coming off the back of extreme dollar strength on one side and extreme dollar weakness on the other side. And some Asian currencies they manage their currencies in order to remain competitive throughout. And I think now we're getting to a time where markets are now freely letting their currencies adjust naturally on the back of these dollar moves. And I think this is just a natural transition, a fair transition. Now, when we look at obviously which currencies are impacted more or less, of course, the renminbi is front of mind when we think about Asia. And I think, the increasing focus on internalization of the yuan.
Yeah, that's another thing that's been talked about here is the idea of de-dollarization. And particularly in the Asian region, will people always see the US dollar as the only and main reserve currency? What are you seeing on that?
I don't see it as a de-dollarization. I call it maybe FX regionalization. And what that really means is, sure, the dollar will continue to remain the dominant currency, but its impact will likely be a little bit lesser and lesser over a period of time. And this is, again, talking about enhancing the liquidity of the renminbi, for example. And I think that is going to remain in play, but it's going to be baby steps. That's what we're going to see. Of course, we also think about Australian dollar. We've done some work as a reserve currency. And it's interesting to see that central banks or foreign investors have increasingly now looked to issue bonds in Aussie dollar and increasingly reflected their interest in investing in the Aussie dollar. And the reason for that is that a lot of curves today, interest rate curves at the long end, are reflecting fiscal risk, political uncertainty, and term premium on the back of that. US is one, UK is another, France, Japan. And, you look at the Aussie dollar curve and it's also paying similar yields, let's say, to the US, not too far out. But we don't have that term premium, that risk, that concern. And I think Australia offers that with our great sovereign standing globally.
And just looking at the next few months, what are the key sort of dates, decisions that people trading foreign exchange or trading or having balance sheets exposed, what should they look out for?
Look, this year has been, for the dollar, a year of chasing headlines and chasing deadlines. I think October is key because we will get the results of the IEEPA tariffs, whether they're legal or not. The other point is to think about is in November, the US and China uncertainty is going to maybe pick up again because the deal has been postponed to then. But, taking a step back, the events we have seen from Liberation Day, April 2, over the various talks in Stockholm and London and in Geneva, it does look like things are not going to be as bad as we anticipated on the 2nd of April. The conversation is now shifting really away from tariffs and more towards specific products. You talk about chips, you talk about magnets, rare earths, and I think that's where the focus will be.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, September the 17th. Catch you tomorrow with the Fed's decision and Chair Powell's initial comments at 5 a.m. Australian time. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.